Let us begin by going over the content for today's lesson. We'll begin by talking about the reasons you in particular should be caring about stop losses. This helps motivate you to actually use them, because if you don't know how they're going to help you make more money, you're not really going to want to use them. Then we'll talk about what a stop loss is, and in particular what a stop loss isn't, because stop losses are not all-encompassing risk management tools. Thirdly, we'll talk about placing a stop loss, the different key variables that go into play when you place a stop loss and how they affect your overall trading system. Then we'll talk about the different types of stop losses and go over detailed pros and cons of each one. And finally, we'll put it all together so you have the key points of this lesson and can begin hopefully testing and applying your own stop losses. Before we continue, please take the time to go over these disclaimers. Why you should care about a stop loss. Now to begin, we're going to use another dice example. Remember, the reason dice work so well in these examples is because a fundamental misunderstanding that most people have is that trading is guaranteed, when in fact nothing is guaranteed when you take a trade. Every time you take a trade, you're rolling a dice because you do not know for certain what will happen next. Let's go over the dice example from the previous lesson. We had a starting portfolio of $5,000, and despite 5 out of 6 times being able to double that portfolio by adding $5,000, because on the 6th time we were getting liquidated, the risk on this portfolio is extreme. And the reason it's extreme is because no matter how much money we make, because our upside is unlimited and our downside is limited, that liquidation means this risk is extreme. Inevitably, we're almost guaranteed to lose it all if we continue trading. Remember, this dice represents a trade. When we roll this dice, we take a trade. And the reason we all need to care about a stop loss is as simple as that. If we always have a chance of getting liquidated, then we'll never be able to trade or invest long term, because we're always at risk of losing everything we gain, no matter how much we gain. So we absolutely need stop losses. What is a stop loss? A stop loss is a limit or market order to close a position at a loss. By its literal definition, it's an order you put in place to limit the amount of money you can lose. If you don't fully understand it yet, don't worry, there are going to be plenty of examples as we go through this, and I'll even show you how to place one in a real life context. I'm now going to break down a little bit further what a stop loss actually does. So a stop loss, while it does protect your capital, it comes at the cost of win rate. Now we're going to use a combination of the dice example and also some charts to show you what this means. Again, we bring our first example, our dice game, up into play. And here, remember, the portfolio is $5,000 and the risk is extreme. Now, what we're going to do is apply a stop loss to this system. Let's take a look at how this system changes when a stop loss is applied. The most obvious change is that instead of getting liquidated, this time we only lose, say, $2,500. The stop loss now prevents our liquidation. However, that's not all it does. It actually affects our win rate. If you take a look at what's happened to the other variables, you'll notice in instances of 4 or 5 rolls, we now end up losing $2,500. Now I'm going to show you with a chart example why a stop loss makes us win less often. Initially, we're going to be trading this without a stop loss. Okay, so this is our entry. This is where we buy at this level, 10.0797. And then we're targeting 25% gain. But we're not using a stop loss. So this disappears. And we're using a bit of leverage as well. At the point at which we go down, say, 15%. So if the price goes down 15%, we get liquidated. Liquidated means we lose all our money. So we need the price to stay above this level in order to make money. And if we take a look, follow this on, price does not reach up there, and it's going down, and over here, you can see that it has hit our level. So at this point, 8.57, we get liquidated. Now, what a stop loss would have done is if we put a stop loss at, say, let's delete this and put a stop loss in, we enter this same trade, only this time, as soon as the price goes under about 5%, then we will exit the position. And then we're targeting again, say 20% gain up there. So if we go, we can see that right over here, we get stopped out and our loss is controlled. So what you just saw is an example where we are saved from liquidation by our stop loss. Now here's a different example. Let's do a very similar one over here where we enter the trade at this level and then our liquidation is 15% again. And our profit target is, let's say, 20%. So in this instance, we are not using a stop loss. So I could even get rid of this and just tell you that over here, we get liquidated. So around this level, which is a drop of, so if the price drops 15%, that's 14.57, but we get liquidated. Now let's take a look at what happens. Well, our profit target gets hit over there and we make good money. Now, imagine we use a stop loss, the same one that saved us from liquidation before. So let's put this in around there. And this time, profit target is still 20%, but our stop loss is at 5%. And then if you look at what happens is that this time, although the price did eventually hit our 20% target, we actually lost the trade early because our stop loss was set here at 5%. That's how when we incorporate a stop loss, though it does protect us from liquidation, occasionally we lose trades where if we waited long enough, we would have hit our target. But such is the cost of a stop loss. It is necessary because without it, you will eventually lose everything. With it, you'll make less money, but you eliminate the risk of losing everything. So in the long run, you end up making more money. The win rate reduction should now be a lot clearer. The second thing it does is put profit into context. Now, the context it provides is in the form of a ratio, and in lesson 4 of this course, we are going to look into this in a lot more detail. What doesn't a stop loss do? A stop loss alone does not encompass risk management. Do not fall under the illusion of safety simply because you have placed a stop loss. The specific placement of your stop loss, the sizing of your positions, the overall system in which you are playing plays a huge role into whether or not your risk is managed. Stop loss is just one section of it, albeit an important one, and if you do nothing else but place a stop loss, it's definitely better than nothing, but it does not guarantee long-term profitability or rather long-term management of risk. Placing a stop loss. The first variable I want to cover is distance of your stop loss from entry. With the previous concepts we've covered, it should be clear, hopefully, that the closer your stop loss is to your entry, the less likely you are to win that trade, because it's more likely for the price to go down to your stop loss before hitting your profit target. And then naturally, it follows that the further away your stop loss is, the higher your win rate is going to be. Of course, it also follows that the further away your stop loss is, the more money you stand to lose, and the closer your stop loss is, well, the less money you stand to lose, assuming the only variable is a stop loss. Now, the specific order type which you place can either be a market order or a limit order. There are two types of stop loss orders. The market order, where your order is guaranteed to execute, though you may not get the exact price you want. And then there's the limit order where you're guaranteed to get the price you want, but it may not execute. Given the stop loss is there for a very specific reason and its job is to execute no matter what once that price is hit, I will always in every instance use a market order over a limit order. And I know very few traders who use limit orders as their stop loss order type, so that can be taken as a highly advised rule. Different types of stop losses. We'll begin with the most basic, and this is a flat percentage stop loss. I'll demonstrate what it is in an example right now. We begin by using this chart over here to decide our entry price. And I can see the price is around 13,478.5. So let's try get an entry over here with a limit order. And we'll use 25%. You can see this meter over here. This platform is Femex, by the way. There's a link in the description below. Highly recommend. They're my preferred trading platform. So we click on 25% and it sets the quantity for our order type. Now what we do is let's just click buy long, and this will get filled automatically because the price has come down a little bit. And you can notice that we can set a take profit. That's when we take our profit before entering, but that's not what we're focusing on right now. What we want to focus on is stop loss, and we can literally just pick a flat percentage, so 5%. If the price goes down 5%, we exit this position, and that's it. It's as simple as that. We click confirm, and our order is set. Then if we zoom out, you can see that our stop loss has automatically been placed over here, and that's the flat percentage. It's extremely easy to set. Now the pros and cons. The pros are, as you saw, it's extremely easy to place. You click a button and you're done. Next, it's also very easy to test. As you backtest, you do the exact same thing every time. And if you do get into automation, it's very easy to automate this and backtest it over a long period of time. The cons are that it does not account for market conditions or relevant price data. So if the market is extremely volatile, you may want to adjust your percentage and not use the same one every single time. Also, if the recent candles are looking extremely large for an asset, so this asset tends to have high volatility, you also may want to change it for the specific asset. So one doesn't account for the asset, and two really doesn't account for market conditions. Invalidation stops. Now these are one of my favorite types of stop losses, and how they work is you actually use technical analysis to place your stop loss. Let me show it in an example. So here we are again. If you remember, we set this previous trade up. Well, I wouldn't really call it a trade, just a demonstration of how to enter this position. So let's close this out, confirm, and that position is now closed. So what we do next is we want to find a position to enter and then have an equivalent invalidation level. So look for a short position right now, because instantly I can see the price is going down a little bit. We're retesting what could be a bit of a resistance. If I zoom out, you can see that this level, this level, this level, it looks like a good resistance. So basic technical analysis, then we'll target the bottom over here. That looks like a good place for support. And then we're going to set our stop loss very tight because we're on the 1 hour. It's not too high a time frame. So we'll go for about 1%. And this 1% is based on the fact that this over here looks like an important support level to me. You can see tested there. We got above, below. So you can see this is an important support. Remember, if you want to learn more about technical analysis, I've got a whole nother free course which is in the description below, which will teach you everything you need to know about technical analysis. And yeah, so I'm using technical analysis to know that if we get up to this resistance level over there that used to be a support, I may want to exit this position. So I now have an invalidation, and you can see this is how I set my stop loss. So now we're going to set this order using our invalidation level. Let's go for a sell. And this gives us all the details of our order. Now we're going to set a stop loss as well. This does it automatically, makes it a market order. And a market order is what we want for our stop loss. Then here's our invalidation level at 13,629.5. Confirm. And now we've entered a short position and we have a stop loss right up there. Fantastic. Now that you've seen it in action, let's go over the pros and cons. Pros are, firstly, they factor in current data. They're not arbitrary and they adapt to different market conditions. They can take advantage of experience. Now, this is a really big benefit because the more time you spend looking at the charts and trading a certain asset, the more you get a feel for the ebbs and flows of this asset. You get to develop subconscious biases that help you make your decisions. This in turn lets you take advantage of discretion. You get to make decisions not based on any data you have, but just your experience. Now the cons are that this is very difficult to test. If you want to test invalidation stops, it normally requires manual backtesting, and believe me, that can take a long time, but it is a great way to develop experience in chart time. Next, obviously, it requires experience. So if you're making decisions which take advantage of your experience, those are going to be almost entirely useless if you have no experience. And not all experience is equal. If you have 2 years of experience losing money in the markets, that's not going to be very useful. Whereas if you have 2 years of experience making decent money in the market, that's going to be a lot more useful. This is also extremely prone to emotional mistakes. And this is because there is no set value. There's no checklist you can tick and follow instructions with. You can be extremely susceptible to your greed, your fear, and these things can heavily influence where you decide to place your invalidation level. Trailing stop losses. Now these are very popular and people love using them because it lets you capture enormous gains. Let's demonstrate this in an example. So now we're going to demonstrate a trailing stop loss. Now this is one of the best things about using a sophisticated platform like Phemex because it actually allows you to do this. Most exchanges don't let you place trailing stop losses. I'll show you how this would work. So again, we decide where to enter. We'll use a market order for entry. We'll click buy and our position is already sized. Now we will enter this position, confirm. Now we go over here to this tab and we can click trailing stop loss. Then we can select a trail value, let's say $200 behind the price. And we can even put in an activation price where it actually waits for the price to reach a certain level before activating the trailing stop, but I'm not going to use that. And we click confirm. And already we now have a trailing stop loss placed. And what this will do is this will follow the price up. So as the price goes up, so this stop loss will likewise follow up and trail with the price. And yeah, it can also be adjusted whenever we want. If we want to make it bigger or smaller, you can see trailing stop loss accepted. As the price goes up, you can see that this is trailing up and constantly updating. And that's your trailing stop loss. Now let's look at the pros and cons. The pros are that, like I said earlier, you get to capture potentially an enormous amount of gains. This means if the price moves a long way, you will continually follow it up. So an overextended trend can make you a lot of money, providing it's not volatile and doesn't retrace back. It's also set and forget. Once you have it set up, you don't have to think about it anymore. You step away and you let the trailing stop loss that eventually becomes a trailing take profit, once it's in profit, handle everything else for you. The cons are, as many of you may have guessed, is that it doesn't give your idea time to play out in choppy conditions. So it may be the case that your price goes well above your entry and gets a little bit choppy, starts going up and down before reaching your target. And in these instances, the trailing stop loss will be hit before you have a chance to capture the full extent of your gains. The next type of stop loss we're going to look over are relative volatility stops. And this is a great point to mention. You aren't limited to just using one of these categories in isolation. And you'll see with something like relative volatility stops, you can actually apply them to a lot of the previous different types of stop losses. Let's show this further in an example. A relative volatility stop uses the price data available to determine the volatility of the market, and then you make your stop loss decisions based off of this. Now, let's explain this a little further in an example. Let's take a situation where we want to enter a short position over here. And just like before, we're going to use an invalidation stop around this 3,000, around this 3,650 level. And our target will be down here. Now, this is pretty much bang on exactly where we expect there to be resistance. And in a highly volatile market, that resistance is often tested. So what we can do is find a measure for volatility. Now there are several types, but for those of you who don't have one, I'll give you an example. You can use ATR. So all you care about is actually that number over here, the 117.5. Because that is the average true range of the last 14 candles. You can customize this once you get a lot more comfortable with it, but the point we're trying to establish is that we have this measure that gives us the average volatility. Now, remember that number, let's say 117.5. We can get rid of this, and then if we wanted to, we can actually add that distance onto here. So let's say 117.5. And that's 118.5, we'll take that just for the purposes of this example. And then we move the stop loss up to there. And that's where we end up placing the stop loss. So now we have our values, we can enter our short just as planned, set our stop loss at 13,767.5. And now what we've ended up doing is combined our previous invalidation point with an average true range stop loss. Now, this position has been placed over here. This can be changed as you please. For example, you can just use the average true range as a stop loss and nothing else. You can add it on top of a trailing stop loss. You can mix and match as you please. The final variable or type of stop loss I'm going to cover are timed stops. Now what these do is they take into account the time you've been in a position, and they use your past data in order to determine whether or not you should exit your position after a certain amount of time, depending on what events have happened. Now these are pretty advanced, so most newer traders don't even need to think about them, but for the advanced traders who are watching this video, a lot of people do incorporate days of the week, weeks of the months of the year, and all sorts of different timing factors in order to optimize their trading. Personally, I don't use these, but I know very well-respected traders who do, therefore they are worth a mention. The pros are that it's very systematic and easily testable because you simply put in X amount of time and it's a flat variable. Then the cons are it requires a really good understanding of the data because you need to find relevant data. You can't just notice something happening a couple Mondays and start applying that into your system, or notice that a couple times after you've been in a position longer than an hour you should have exited. That's not quite enough. This needs to be quite intricate, detailed data, and with that con comes that it adds a lot of complexity, and it also requires a certain amount of experience to execute simply because of the complexity requirements. And there you have it, everybody. Absolutely everything you need to know about stop losses. Now, what I'm going to do is bring it all together so we can highlight the key points that you need to have taken away from this lesson. Firstly, the distance win rate relationship. Remember, the closer your stop loss is, the lower the win rate's going to be. The further away the stop loss is, the higher the win rate's going to be. If you do not understand why, go back and rewatch my examples or go research outside of this lesson. It's very important you understand why these things happen so you can be flexible when you use your systems. Next, remember to use market orders. This one you don't even need to understand. Just know that with your stop loss you should be, unless you're very advanced and have a very specific reason, using market orders so they're guaranteed to execute. And remember, you have my full list of pros and cons of a whole bunch of different types of stop losses, and there are many more stop losses as well, but this gives you everything you need to get started as a beginner, and as a more intermediate advanced trader, it'll give you a further understanding. As we said earlier, remember, a stop loss alone is not enough. If you subscribe to my channel and turn on notifications, you won't miss out on next week's lesson where we cover position sizing and risk. After that lesson, combined with this one, you will have a very complete and fundamental understanding of the risk you take on when you enter a position and can really get down on controlling your risk. I hope you enjoyed this lesson, and thank you very much for listening.